Hey everyone, welcome back to Corporate Decoder, the place where we take a deep dive into the financial underbelly of big corporations and spill all the tea. Today we are cracking open the latest 10Q filing from Income Opportunity Realty Investors Incorporated. Get ready because you will not believe the story these numbers are telling. Before we dive in, make sure you are subscribed for more of these decoding sessions and join our Discord community, link down below to chat about what we uncover. So this report filed on November 6th, 2025 covers the quarterly period that ended September 30th, 2025. It gives us a snapshot of where Income Opportunity Realty Investors Incorporated where they stand financially. Now, this company focuses on investments in mortgage notes, receivables, and their main income source is interest from related parties. That is a big clue right there about how their business is structured and where potential risks might lie. Right off the bat, we see that as of early November 2025, they had just over 4 million shares of common stock out there. This gives us a baseline for calculating things like earnings per share. Now let's get into the juicy part, the financial statements. This is where the real story unfolds. Looking at the consolidated balance sheets as of September 30th, 2025, we see their assets total about $124.9 million. That is up slightly from about $121.9 million at the end of 2024. A significant chunk of that, over $113 million, is in current assets, and most of that is from receivables from related parties. This is a recurring theme, money owed to them by, well, parties related to them. When we look at the equity side, their common stock is valued at a nominal amount, but the additional paid in capital and retained earnings are where the real value is. Their retained earnings, which is the accumulated profit not distributed as dividends, stand at about $64.7 million at the end of September 2025. Moving on to the statements of operations, this is where we see how much money they are making or losing. For the quarter ending September 30th, 2025, they reported a net income of about $1.03 million. That is down from around $1.2 million in the same quarter of 2024. For the 9 months ending September 30th, 2025, their net income was about $3 million. This is also a decrease compared to nearly $3.5 million in the first 9 months of 2024. The big reason for this dip in profit seems to be a decrease in interest income from related parties, which we'll touch more on later. The statement of equity shows the changes in the company's net worth over time. We can see how net income affects retained earnings. For example, in the third quarter of 2024, they had a net income of $1.2 million, increasing their retained earnings. They also repurchased some common shares that quarter, leading to a slight decrease in total equity. Now let's talk cash flow. For the 9 months ending September 30th, 2025, their operating activities used about $77,000 in cash. This is a change from the same period in 2024, when operating activities actually provided about $718,000. This shift from generating cash from operations to using cash is something to keep an eye on. Investing activities provided a small amount of cash from collecting notes receivable. These notes are crucial as they explain the numbers in the financial statements in more detail. The company Income Opportunity Realty Investors Incorporated is managed by Pillar Income Asset Management Incorporated, which is a related party. This relationship means a significant portion of their transactions will involve this related entity. Transcontinental Realty Investors Incorporated and American Realty Investors Incorporated are also significant players in the ownership structure, holding large stakes, which means their financial results are consolidated. Here they explain the accounting rules they follow. They use generally accepted accounting principles or GAAP, but they tell us that some information is condensed, so we should refer to their annual report for full details. They also mention consolidating variable interest entities where they are the primary beneficiary. They have a note receivable from Unified Housing Foundation Incorporated, or UHF. This is a bit of a mouthful, but essentially it is a loan to UHF that generates interest. They consider UHF a related party because their investment performance is tied to the collateral supporting that loan. The interest rate on this note changes based on market conditions like the Secured Overnight Financing Rate, or SOFR. This is a really important section. They explicitly state that transactions with related parties cannot be assumed to be on an arm's length basis. This means the terms might not be what you'd see between two independent companies. They mention advisory fees paid to Pillar Income Asset Management and interest income from these related party receivables. The receivables from related parties were a massive $13.7 million at the end of September 2025, up from $110.5 million a year earlier. This concentration in related party transactions is a major characteristic of their business model. They have a stock repurchase program allowing them to buy back shares, As of September 2025, there were over 513,000 shares remaining that they could repurchase. This shows they are managing their share count. This section is a bit concerning. They state they believe they will generate excess cash from property operations in the next 12 months, but they add a caveat that this excess cash might not be sufficient to cover all their obligations as they become due. This is a clear red flag about their liquidity. This just confirms that they've looked at events that happened after the 30th of September 2025 up until November 6th, 2025, when the report was ready to be issued. Now, for management's own take on things, they flagged that this section might contain forward-looking statements. They are essentially telling us what they think might happen in the future based on current information. They also list several risks and uncertainties that could impact their actual results. These risks include things like the availability in terms of financing, the risk of not managing growth effectively, and potential liability for uninsured losses. They also point back to their annual report for a more detailed look at these risks. They reiterate that they invest in mortgage notes and their main income is from related party receivables. They emphasize again that related party transactions might not always be in their best interest. This constant repetition about related parties is a huge signal about the company's operational structure and its potential vulnerabilities. They highlight a few key accounting policies, including how they value financial instruments using a fair value hierarchy. This hierarchy categorizes assets and liabilities based on the reliability of the inputs used to determine their value. Level 1 is the most reliable based on unadjusted quoted prices, while level 3 is based on unobservable or internal data. They explain that their operating expenses are mainly general and administrative costs paid to related parties. They also have interest income from notes receivable and funds deposited with Pillar. Management attributes the decrease in net income during the third quarter of 2025 compared to 2024 primarily to a decrease in interest income from related party receivables. Similarly, the drop in net income for the first 9 months of 2025 compared to 2024 was also mainly driven by lower interest income from these related party receivables. This is a critical point. Their profitability is heavily tied to interest income from related parties, and when that income goes down, their overall net income shrinks. Here they talk about how they fund their operations. Their main cash sources are collections from mortgage notes and receivables from related companies. They anticipate that their current cash plus what they expect from related party receivables will be enough to cover their needs for the next 12 months. However, remember what they said in the commitments and contingencies section about that cash possibly not being sufficient to cover all obligations as they become due. That contradiction is a major point of concern for investors. This section is marked as optional and not included in this report. They state that their disclosure controls and procedures were effective, meaning they are reporting information accurately and on time. There have been no material changes to their internal control over financial reporting. This part covers other miscellaneous but important information. No legal proceedings to report. They state there have been no material changes to the risk factors disclosed in their previous annual report. This implies the risks they've previously identified are still very much in play. They mention their stock repurchase program again, noting that no shares were purchased in the first 9 months of 2025. As of the 30th of September 2025, over 1.1 million shares had been repurchased under the program, with over 500,000 still available for repurchase. No defaults to report on senior securities. Not applicable to this company. Nothing to report here. This lists all the attached documents and incorporated exhibits, which are essentially the legal documents and corporate governance details related to the company. And finally, the signature page signed by the CEO and Chief Accounting Officer, certifying the accuracy of the report. So, what is the verdict on Income Opportunity Realty Investors Incorporated? Looking at their financials, it is clear this company operates with a very heavy reliance on related party transactions, particularly in the form of receivables and advisory services. While they are generating interest income from these parties, the decrease in this income directly impacts their net profit, as seen in the year-over-year comparisons. The significant balance of receivables from related parties, even growing slightly, suggests a concentrated business model. A major concern is their liquidity. While management is optimistic about meeting short-term needs, the earlier statement about excess cash potentially not being sufficient to cover all obligations as they become due is a serious red flag. This could indicate potential cash flow issues down the line. The company is stable in terms of reporting and controls, but the core business strategy, heavily dependent on related parties, carries inherent risks. Their direction seems to be maintaining the status quo with minor adjustments. The main opportunity here would be diversification away from such a heavy reliance on related parties, but that appears to be a long-term or unstated goal. On the risk side, the dependence on related party income remains the most significant vulnerability. Any change in these relationships or their financial health could directly and severely impact Income Opportunity Realty Investors Incorporated. In conclusion, Income Opportunity Realty Investors Incorporated presents a picture of a company with a stable but highly concentrated business model. The numbers show a slight dip in profitability due to decreased interest income from related parties and a worrying note on potential liquidity challenges. For investors, understanding and assessing the risk associated with these deep-rooted related party relationships is paramount. That is our breakdown of Income Opportunity Realty Investors Incorporated's latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives into corporate documents. Don't forget to check out the Discord in the description to continue the conversation. Thanks for watching. See you next time.